Warren Buffett says, be greedy when others are fearful. Daniel Kahneman says, you're wired to lose money doing exactly that. One of them has $50 billion. The other has a Nobel Prize. And both of them think you're making the same mistake right now. Here's the truth nobody tells you. Every time the market crashes, every time your portfolio turns red, every time CNBC screams recession, your brain is running two programs at once. One program is screaming, buy, this is the opportunity. The other is screaming, run. You're about to lose everything. And whichever voice wins determines whether you build wealth or watch it disappear. But here's what's disturbing. Most people think this is about discipline, about willpower, about being smart enough to ignore fear. They're wrong. This isn't about intelligence. It's about neuroscience. There's a reason your brain sabotages your portfolio, a reason why the smartest people make the dumbest financial decisions. A biological glitch buried so deep in your neural architecture that even knowing about it won't save you, unless you understand the pattern. Let me show you something. Think about the last time the market dropped 10%. What did you do? Did you check your portfolio? Once, twice, 17 times in one day? That's loss aversion. Your brain treating a 10% dip like a physical threat. Because, to your amygdala, losing money feels identical to being chased by a predator. Your heart rate spikes. Your cortisol floods. Your prefrontal cortex, the part that makes rational decisions, shuts down. And suddenly, you're not an investor anymore. You're a frightened animal. Making survival decisions with retirement money. Now here's the twist. While you're panicking, Warren Buffett is buying. Not because he's braver, not because he's smarter, because his brain doesn't process fear the same way yours does. And this is where Kahneman enters the story, because he spent 40 years proving one thing: your emotions are bankrupting you. He called it prospect theory, the discovery that won him the Nobel Prize in economics. And the conclusion was brutal. People feel losses twice as intensely as gains. You need to make $200 just to emotionally recover from losing $100. That's not a strategy. That's a design flaw. So when Buffett says be greedy when others are fearful, he's not giving you advice. He's exploiting your psychology. He's buying your fear at a discount. But here's the question nobody wants to answer. What if fear is right? What if loss aversion isn't a bug, but a feature that's kept humans alive for 200,000 years? There's one thing Buffett never tells you, one statistic that changes everything, and it's hiding in the data. Let's talk about catching falling knives. That's what traders call it when you buy during a crash. Because most of the time, you just bleed out. 2008. Lehman Brothers collapses. The S&P 500 is down 40%. Buffett's advice rings in your head. Be greedy. So you buy. You max out your credit. You liquidate your emergency fund. You go all in on the dip, and the market drops another 30%. Now you're sitting on a 70% loss. Your retirement planning is destroyed. Your wife is crying. Your kid's college fund is gone. And Buffett, he's fine. Because Buffett has something you don't. Cash reserves. Time horizon. Emotional detachment. He can wait 20 years for the market to recover. Can you? This is what Kahneman understood. Loss aversion isn't irrational. It's a survival mechanism. Because in the real world, most people can't afford to lose 70%. They don't have Buffett's safety net. They have mortgages, medical bills, rent due in 30 days. For them, fear isn't the enemy. Fear is information. So here's the paradox. Buffett is right if you're Buffett. Kahneman is right if you're everyone else. But there's a third option, a framework that bridges behavioral economics and wealth management. And it starts with understanding your own money mindset. Most financial advisors won't tell you this, because if they did, you'd realize you don't need them. The secret isn't about picking stocks. It's about knowing which version of yourself is making the decision. Let me explain. Here's the framework. The two-brain portfolio. Your brain has two systems. Kahneman called them System 1 and System 2. System 1 is fast, emotional, driven by loss aversion. System 2 is slow, logical, driven by compound interest calculations. And they're fighting for control of your money. Most people let System 1 win because System 1 is loud. It's the voice screaming, "Sell! Protect yourself!" But System 2 is the voice that whispers, "Market volatility is noise. Asset allocation is signal." So how do you design a portfolio that satisfies both? Step 1. Split your capital. 80% goes to System 2. This is your long-term bucket. Index funds, dividend growth stocks, real estate investment trusts. This money is emotionally off limits. You don't check it during crashes. You don't sell during panics, because System 2 doesn't panic. Step 2. 20% goes to System 1. This is your sleep at night money, high-yield savings account, treasury bonds, cash equivalents. This bucket exists to calm your amygdala. When the market crashes and your brain screams, "Do something," you can. You can reallocate. You can buy the dip, but you're not gambling with your future. You're gambling with money your emotions can afford to lose. This is the secret Buffett won't tell you. He's not fearless. He's structured. His entire empire is built on separating emotional decisions from strategic ones. Berkshire Hathaway's cash reserves, that's his System 1 bucket. His equity holdings, System 2. And here's where it gets interesting. When you design your portfolio this way, loss aversion stops being your enemy. It becomes your competitive advantage, because now, when everyone else is panic selling, your System 1 bucket is satisfied, your fear is managed, and your System 2 brain can execute Buffett's strategy. You buy when others are fearful, not because you're brave, because your psychology is optimized. But there's one more layer, one psychological trap that destroys even people who follow this framework. It's called cognitive dissonance, and if you don't understand it, you'll sabotage yourself at the worst possible moment. Here's how. Let's say you do everything right. You build the two-brain portfolio. You separate emotion from strategy. Then the crash happens. March 2020. COVID hits. The market drops 35% in 3 weeks. Your System 2 portfolio is bleeding. Your System 1 bucket is safe. You're ready to buy the dip. But your brain does something unexpected. It starts rewriting history. Suddenly you remember, wait, I read an article. This isn't a normal crash. The fundamentals are different this time. Maybe I should wait for more data. This is cognitive dissonance, the psychological pain of holding two contradictory beliefs. 1, I believe in long-term investing. 2, I'm watching my net worth collapse in real time. Your brain can't handle the tension, so it creates a narrative, a story that justifies inaction, and you miss the opportunity. 2 months later, the market recovers, then surges. People who bought in March made 40% returns. You made 0, not because you didn't have the strategy, not because you didn't have the capital, because your narrative overpowered your framework. This is what Kahneman warned about. He spent decades studying this. He called it the narrative fallacy, the human need to create stories. even when the data says otherwise. And here's the brutal part. The smarter you are, the better your narratives. A high IQ investor doesn't say, "I'm scared." They say, "I'm waiting for technical confirmation. I'm concerned about macroeconomic headwinds. I'm practicing prudent capital gains management." It's fear dressed in a suit. So how do you beat it? You automate. You remove the decision entirely. Here's the framework. The crisis protocol. Before the crash happens, you write down your rules. If the S&P 500 drops 20%, I buy X dollars. If it drops 30%, I buy Y dollars. If it drops 40%, I liquidate my System 1 bucket entirely. No exceptions, no narratives, no rethinking. Because in the moment of crisis, your brain will lie to you, your rules won't. This is what separates professionals from amateurs. Amateurs rely on discipline. Professionals rely on systems. They don't trust their emotions. They don't trust their intelligence. They trust their protocol. And when the crisis hits, they don't think. They execute. So here's what I want you to do. Right now, pause this video. Open your Notes app and answer one question. Are you a System 1 investor or a System 2 investor? When the market drops 10%, do you feel it in your chest? Do you check your portfolio obsessively? Do you start Googling recession indicators? That's System 1. Or do you feel nothing? Do you see red numbers and think, discount? Do you automatically calculate dollar cost averaging opportunities? That's System 2. Here's the truth. Most people are 90% System 1, and they're investing like they're System 2. That's the mismatch. That's why they lose. Not because they're dumb, because they're misaligned. Drop your answer in the comments. System 1 or System 2? Be honest, because this framework only works if you know which brain you're working with. Let's bring it home. Buffett versus Kahneman. Greed versus fear. Both of them are right. Buffett is right that market volatility creates opportunity, that compound interest rewards patience, that emotional discipline builds wealth management. But Kahneman is right that you're not wired for this, that loss aversion is real, that behavioral economics predicts your failure, unless you design around it. So what's the answer? Timing is psychology. The best investors don't fight their emotions. They architect around them. They build portfolios that satisfy both brains. They create protocols that remove narrative. They automate decisions before crisis hits. And they stop pretending they're Warren Buffett. Because Buffett has something you'll never have: 50 years of experience, infinite capital, and a brain that processes fear differently. But you have something Buffett doesn't: youth, time, the ability to learn from his mistakes without losing billions first. So here's your action plan. 1. Calculate your two-brain split. How much goes to System 2? Long-term, untouchable. How much goes to System 1? Emotional safety net. 2. Write your crisis protocol. What are your buy triggers? What are your rules? No narratives, just numbers. 3. Automate everything you can. Dollar cost averaging, automatic rebalancing, dividend reinvestment. Remove the decision, remove the emotion, remove the failure point. Buffett and Kahneman both understand one thing: the market doesn't care about your feelings. But your feelings, they control everything. Your portfolio management, your retirement planning, your entire financial future. So the question isn't, should I be greedy when others are fearful? The question is, have I built a system that lets me execute that strategy when my brain is screaming the opposite? Because that's the real edge. Not intelligence, not information. Architecture. The investors who win, they're not the smartest, they're not the bravest. They're the ones who designed a portfolio that works even when they don't. That's the lesson. That's the difference between Buffett and everyone else. He's not playing a different game. He built a different brain, and so can you.